Okay, so this is just a quick video on trading the Lottos on stock options for the bigger name stocks. Let's first, and the question came up about XPEV because I had said in the option alert room, I said the XPEV is a stock is strong. Look at the June 18th 42. It only has a 30-cent premium to the market. And so that was, and there was a reason I picked the June 42s. Let's just have a quick look at the stock first. And you can see here's the delay on this. So you can see that the stock was strong this morning, and when I talked about it, that time was 10 a.m. here. And the stocks were, so this is when I said that the stock looked strong. It did pull back, but then got into this nice rising channel. This is the option price compared to the stock. And so let's go back to the options. So first of all, what we want to try and do is find one that has volume in it. So we see that the June 40s really is the start of it. They've traded 1.1. They've traded 1,100 options. The 42s had traded 2,700. 43s are more active, 4,200. And then as you get further out of the money, well, then here's the gamblers, 4,500. And you can see the open interest on the 42s is 2,600 share options on it. And it's currently 207 to 223. So these options, these are call options that gives you the right to buy the stock at $42. If you took the 42s, that means that gives you the right to buy the stock at $42 until June 18th, which is tomorrow. So these expire in the near future. So they are trading with just a small time premium. Let's just talk about time. So time premium is the difference between the actual price of the stock and the option that you take plus the premium for the option. Now, what I mean by that is if there was no time premium, you were going to buy the $42 call option, you would pay $2.11 for that. There'd be no time premium. But they do have a bit of a time premium on them. We can see here in this candle, the stock was 44.37 and the option was 3.46% premium above the price. So it was at 250. So this is trading at 44.20. The 20s were trading at 250, so that would be 44.50. So there's a 30-cent time premium. And because that's the intrinsic value is the $2, the 42 to the 40, 44.30 or 44.20. That's your time. That's your intrinsic value, $2.20, and then the 250, which it was trading at. So that 30 cents is the time value. And as the option gets closer to expiry, that time value evaporates and it decays and goes back to zero. Tesla, for an instance. Here's the Tesla's trading at $616. These expire in June, 21st on the 18th of June, and the 615s are $6.35. So that's a $5 time premium. between now and tomorrow afternoon, either that time premium is going to decay to, if Tesla just kept trading sideways here at 616, that $6 time premium would shrink down to $1.50 if it stayed at exactly the same price. So that $5 time premium, as this stock moves up and down, is going to decay to zero, and at the close of business will be equal. The option will be equal to the price. If it's in the money, will be equal to the price of the stock. If it's out of the money, which means it's, say the 625s here, if it stayed at 616, it's the 625s, this whole time, this is all time premium, 257, 264, it would go to zero, and the options would expire worthless because they're out of the money. Now let's see if I can find how I did that. Just takes a second to populate it. So let's get back to this. Let's see if that didn't fill it in. So this one moment. So we see that so we had that 30-cent time premium. So the point is, so how do we trade this, and how do you know which ones to take? Well, so as I was saying earlier, the first thing you want to do is you need to find one that's liquid, that has some volume to it. The 42s, 43s, and 44s, 45s, those are all the ones that are trading with volume. At the time that this stock, when we were looking at it, was trading at 40. When we were looking at it, it was trading at here. It was trading at around $42. Yeah, 43. It was the breakout over 43 that I was looking at. And so you want to trade the Lottos this close in. You need to be at the money or in the money. At the money would have been the 43s if it was trading at 43s. In the money would have been anything under 43. So we're looking for options that have volume to them, and an interest in them, and are also in the money. So the 42s, the 43s were a bit expensive, and they were at the money. So I wasn't really interested in trading those ones because the time premium was so much bigger. At the money, the time premium was only, or in the money, the time premium on the 42s was only 30 cents. So because two things are going to happen. If the stock starts to surge, the time premium is going to expand. It's going to be bigger because people are rushing in to buy the stock. They're prepared to take the risk that that time premium is going to be compensated compensated by the move in the stock. The vice versa, if it goes against you, the time premium is going to decay very quickly. And it'll go, and so not only will you lose intrinsic value as the stock falls off, but you'll also lose the time value very quickly when it goes against you to the downside. Now, don't forget, when you're trading these options, it in a sense is not in a sense, it is highly leveraged. If I buy 100 shares of XPEV at 43, that cost me $4,300. Well, I can at $1.75, when I bought the 42s, I could buy 3 call options because they're 100 shares apiece. So I've got 3-to-1 leverage on my money, and so the stock will, and so when you're trading the Lottos, they'll move. Especially if the smaller the time premium, they'll move penny for penny with the stock. So if the Lottos were at $43 or $42, which I took. Just let me check to make sure which ones I took. Sorry. Yeah, I took the 42s. They were trading at $1.75. So when this went to 45, when this traded to 45, those options traded to 250. So I went from 175 to 250, a 75-cent move. So 50% on my money. Whereas the stock itself went from 42 to 45. That's $3. And sorry, went from 43 to 45. So that's $2. So that's only a 5% move. Whereas when owning the options, I got a 50% move. I made 75 cents on my $1.75. So it is, it's highly leveraged, but it's because you're trading a $45 stock that can move very quickly up or down, but you're only paying a fraction of that by owning the option to purchase it. So that's one of the risks for sure. It's one of the great rewards, but it's also the risk in that if the market goes against you, you're going to see a shrinkage of the time premium as well as the intrinsic value as the stock sells off and the option follows it on the way down. But the same happens on the way up, except the time value will, and if you catch it right, could increase and you could get a bigger spread that way. But typically as it goes up, the time value also continues to erode away. So you may not get it may not move dollar for dollar. For instance, I bought this at 43, it went to 45, but my option didn't jump $2, it only jumped 75 cents. It went from, the 42s went from 175 to 250. So it wasn't a $2 move. So I lost some on the time premium. The time premium eroded away as it went up. So what does this all mean? I guess it means that when you're going to trade the options, the lottos, you're looking for ones the closest in, which in this case is the June 18th. You're not holding these overnight. They're strictly a day trade. You can't hold it overnight. It's too dangerous. You could lose the whole amount. And you want to find ones that are liquid. You want to find in the money, and the ones that have the biggest interest or and the biggest liquidity to them. Now this at 2,700 isn't big liquidity, so they had big spreads to it. You can see right now it's 208 to 235. So that's a pretty big spread on those options. And the further you get out of the money and the cheaper the option gets, the spread closes down. The further in the money you are, typically the bigger the spread. The bigger the spread. So just to recap that, you want to look at the closest option in that's expiring soon. It's only a day trade, and you want to find in the money stocks that are trading that have volume to them. They have to have some volume, probably over 1,000 volume to it. Probably. If you look at the big stocks like the Tesla and all those ones, or these ones like AMC, they're trading 60, 70,000, 100,000 contracts. So, in this XPEV is not that, doesn't have that much volume. But you can take them and run with them because they'll give you it'll highly leverage your money. You can buy way more of them. And if the stock is trending up strongly, you just ride with it and take the trade. So